Well, g'day there everyone. Thanks a lot for joining me as at this Wednesday afternoon market recap. Boy, wasn't that weekend discussion rather timely, because again today, really Monday through Wednesday, we have seen continued selling pressure. In fact, the Dow Jones Industrial Average from the intra-session highs did reverse a 450-point move during the session, and we closed down very close to 0.75%. What we have here is a changing technical picture, and you need to be made very well aware of what to expect moving forward. I am going to go through, I guess, comprehensively more so that of the market update, and we may even recap a couple of individual stocks that are showing us also some very interesting signals. Now, again, the Dow Jones Industrial Average, as at today, as at the close on Wednesday, has once again pronounced another long up week. We have in fact closed the gap taking us back to Friday and Monday, and we did overshoot that but see a very strong reversal. Also on top of this, we have blown right through this structural support. Now in the past, this has been a series of rising lows, or at least a series of higher lows. That is now finished. It has reversed. We have broken below the support area, and we have also broken above this rising bullish trend line, not to mention, of course, this up wick, which is also acting as some form of a back test of this rising trend line, which is now acting as resistance, and the closure of that gap between Friday and Monday. This market, as at the close on Wednesday, is exceptionally weak. The control right now is with the bears, and it looks as though this market is going to be driven back on down to roughly this 23,750 area. If I make this extension over to the right hand side of my screen as I've just done, this now becomes a very firm target. And in all honesty, as we look at this market and we, I guess, assess just what is happening structurally speaking, this does not have to be the definitive support area of the market moving forward. Over the weekend in Pro, we discussed this, but as for the immediate downside target, especially when we're talking about the industrial average, it makes sense for us to come on back down and retest this horizontal area of support. What we'll do is we'll have a very honest and candid discussion down at this level, if in fact we get there this weekend or by this week's close, and we'll assess this moving forward. But at the moment, I don't want you to be under any false illusions that this market is strong or it is healthy. It is immediately weak, and it has been weak since this transformational process over here, when we essentially started to see a lot of divergences begin to show up between the industrial average, the S&P 500, and also the NASDAQ. Now, where these markets get a little bit choppy, and again, the narrative over the weekend was to think about the market in a defensive manner, really limit or at least adjust those stops up higher, and then to think or at least wait about this market pulling back down into lower areas of support. The S&P 500, if I can zoom out and show you this, it is still holding above this rising bullish trend line. You can see here that unlike the Dow Jones Industrial Average, we are still making a series of higher lows. We are still printing in essentially that fourth most recent high low, which still gives us a shorter term intermediate bullish trend line, which is still in effect. We don't have the definitive signals yet that this has broken and that it has reversed. However, if you take a look at the candlesticks even, we've got some exceptionally bearish sort of candlesticks here, and we also have this pronounced gap between Friday and Monday, very similar to that of the industrial average. All that we haven't done at the moment is broken below this trend line. It looks as though even heading into the close on the S&P 500 on Wednesday that we are flirting with this bullish trend line. And if we do begin to crack below this little swing low, which takes us back to the late stages of May 2018, well, again, the doorway opens for the S&P 500 to come on all the way back down to 2,600. Now here we are, we're trading at 2,700. This does not mean that you run out and buy a bunch of puts on the S&P 500 or you buy a bunch of puts on the Dow Jones Industrial Average, whether or not you want to trade the SPYs or the diamonds. In fact, you would rather wait for these markets to move back into that of a really definitive support area. Okay, we are potentially at one on the S&P 500 at the moment, but you have to expect volatility to persist at least through Thursday and Friday as we move into the weekend. This market is most likely going to be choppy. And the reason why we are suggesting this is because the markets are really not confirming one another. Now, the reason they're not confirming one another is because the NASDAQ most recently has pushed on up to a new all-time high. And we became very concerned when we saw this gap over here mixed with this engulfing candlestick. It was looking like that of potentially an exhaustion gap. In fact, what we saw again between Friday and Monday was another gap to the downside, another bearish Morobozu candlestick. It did have that of a lower wick. However, we stabilized it yesterday a little bit, but you can see the bottom more or less falling out of the NASDAQ. This looks to me right now to be some form of an exhaustion mixed with an island reversal sort of chart pattern. And we're starting to see the NASDAQ pulling back down more so into the sort of territory that we've been operating with the industrial average and the S&P 500. They are moving back somewhat into synchronicity, or at least the NASDAQ itself has pushed on back down from those all-time highs, and we are sort of in that of a correctional type of phase at the moment. We've got exceptionally bearish candlesticks. This is happening on elevated volume. And also, if I go back into the Dow Jones Industrial Average, if I can bring up these long-term simple moving averages, this is the third consecutive session where the Dow Jones Industrial Average is actually closed below that of a very slight rising 200 simple moving average. You can see the dynamic of the 100. It is starting to shift to the downside, and with price action actually below both of these long-term simple moving averages, it does look as though we may be entering into that of a correction. I'm not calling this at the moment that of a terminal market reversal, but we have to see what happens, obviously, when we come on back down to 23,750. This is very important. It's very rare that the industrial average does actually close below the rising 200 simple moving average. In fact, I think it's the first time, or at least it had happened for the first time on Monday since, I believe, Brexit back in 2016. So this is largely a very important signal, although it doesn't justify anything larger, at least in terms of a correctional type of move or into a bear market at least. But it is quite rare to see this market price below that of the 200 simple moving average. Again, it looks like the rising wick here, or the upper wick, is retested or very close to tag that sideways moving 100 simple moving average as well. And again, if we just bring up the S&P 500, you can see that we did close below this simple moving average, or at least the 100-day simple moving average. These are not definitive areas of support, not all of the time. They do work quite nicely when it overlaps with horizontal resistance and other bullish trend lines. But at the moment, it's giving us rough areas of support areas that at the moment I've got no intention of playing. And I'd really recommend that you have no intention of buying this market at the moment. You should be thinking defensively and really just sitting on the sidelines, waiting for this market to move back into a really logical area of support before we set up bidirectional trades moving forward. Now, apart from that, I've recapped, of course, the NASDAQ, the S&P, and the Dow Jones Industrial Average. Again, just to reiterate, you should not be looking at this market bullishly at the moment. It's far too early, and there is going to be probably that of volatility persisting for the foreseeable future. If I bring up that of the Russell 2000, you can see that we are reversing quite strongly as well. We never got all the way up to 1,726. I still think there's a chance we are going to get there, especially if this support area holds. But you can see for yourself, even the Russell 2000s, when we're talking about more so the broad scale of the market, you can see we've got long day Morobozu candlesticks, and we are, if I bring up these exponential moving averages, coming back down to the rising 50 EMA. We are very comfortably below all three of the exponential moving averages on the Dow. We are also below, as at the close on Wednesday, below all three of them on the S&P 500. The difference and the exception is, or at least not at the moment now, but you can see that we've just slightly closed below that rising 50 exponential moving average. The dynamic, the angle of these exponentials is a little bit different on the NASDAQ compared to that of the Dow and the S&P 500. The slope of the 50 is still largely bullish on the NASDAQ, but you can see we are piercing below this as at the close on Wednesday. Expect this market again possibly to move sideways, but I would not be gravitating towards long trades at the moment. I would not be buying into that sort of temptation to do so. I think it is premature, and we are going to see lower prices moving forward. All right. Outside of that, we've got the transportational average as well that has reversed quite considerably. We were very interested in this pattern over here when it's set up. This is what we call a continuation pattern. It is a 4-day continuation pattern. We never saw the confirmation of move above the highs of these candlesticks to take us on up back up into 11,336. In fact, we've reversed, and we're coming back down to old areas of support on the transportational average as well. So that is a very quick recap of the market indices. Also, I wanted to show you, this is a very interesting chart pattern, also mixed with the candlestick pattern on Netflix. I was discussing this over the weekend. This looks like a diamond reversal pattern, and it also looks like an island reversal. Now, considering today's session, we did actually close the open window between Friday and Monday. However, we're seeing another series, or at least consecutive gaps, which are being sold. So this is a bearish continuation signal after this reversal signal here. So Netflix is looking tremendously weak. I would not be wanting to jump into this at the moment. I would not be looking through the lens of that of the rising exponential moving averages. At a minimum, you should expect Netflix to come all the way down to about $350 per share. It may even come down to $330 per share. It just depends how deep this correction is going to be. On the equity markets, we've got Tesla again, which is holding up okay considering some of the movements we're seeing in the equity markets. But this picture here is very ugly. This is looking like a bear flag continuation pattern. And it would not surprise me to see Tesla over the coming weeks potentially trade back all the way down to $280 per share. Now, we've got Google as well, which is absolutely tanking. This is after our most recent trade above 1151 up to 1189, and after some of these trades back here to take advantage of this rising move over the weekend. Said, avoid this, stay away from it. This is most likely probably going to bounce from this level, as odd as that sounds, and it's really just going to frustrate a lot of people. It's going to whipsaw a lot of people back and forth, buyers and sellers, and it's something right now, again, much like the indices themselves, just to stay away from, to avoid. Not to really allocate capital at this particular moment, trying to chase either, some form of an irrational bounce or that of a continued sell-off move. It's just not the time to be placing swing trades. This is a rather volatile market and you need to avoid it. You've got CVX. This is looking like a shooting star candlestick, an upper wick, really going nowhere, stuck moving sideways. Pay attention to the Bollinger Bands. They are going to continue to squeeze, and we are probably going to set up that of a Bollinger Band break moving forward. The same is true for COP. We've got another shooting star candlestick over here. No major directional movements whatsoever. We are moving towards the apex or that of a squeeze, which is occurring underneath the price action. Caterpillar under huge pressure. Upper wick today, down another 93 cents, breaking below this purple box. I'm not gravitating towards that of a trade on Caterpillar. I'm not gravitating towards really any trades at the moment. I'm just simply watching this market and looking for, well, where is that next major directional swing going to take place from? When and if we get down to those support areas. Baidu down $7.77. Interesting. It looks as though we are breaking this bullish upward trend line. But very similar to the industrial average and also the S&P 500, which are bifurcated, are mixed at the moment. You want to pay attention to this most recent, or at least, the last consecutive higher low. So if we start cracking below really $240, probably $235, we may be in the very early midst of a reversal taking place on Baidu. But obviously at the moment, we don't have confirmation. We are still technically holding up above this most recent high low. If I can bring up Boeing Airlines as well, you can see just here that we're moving, or at least trying to move to the downside. We do have another shooting star. So you see this series of individual stocks that we've gone through, most of them do have upper wicks, or they have been tremendously bearish sort of candlesticks. This is telling us that there is still weakness in these markets, and it makes a lot of sense given the price action in the candlesticks that have been set up today on the broader sort of market indices. Amazon, another outside day engulfing candlestick. Weakness, weakness, weakness. Caterpillar, look at this, another upper wick. So I think you understand the narrative of the market, understand some of the basic price action when it comes to our top 12 individual trade list. Again, very important, be defensive. Think about what we spoke about over the weekend and just let this market settle before, again, jumping into a bunch of additional, or at least new trades. Now, if I continue with this, the US dollar did see a little bit of a bid today. If I can bring this up, we did close up another 71 cents on the US dollar index. Still not looking at this long. This is still contributing to the volatility which is underway in commodities, which really segues us into GLD. GLD is continuing to move to the downside. This is such a surprise again. We've not only broken this trend line here, but we've also broken this secondary decelerating fan line. This is this old support area coming in at about $120 on the ETF. Now, I am personally, speaking for myself, stopped out of this trade. I'm just letting this settle. Again, I do think we are going to see a tremendous rise in due course. It obviously isn't now, whatever the reason is. This is very disappointing to see this type of move happen in gold. It doesn't really make all that much sense when we're seeing, again, the equity markets continue to fall. There just simply isn't a bid in commodities at the moment. And again, this is largely attributed to that of continued strength in the US dollar, but at the same time, there is a very good chance that this current pivot at 95, so to speak, on the US dollar may be ultimately that most recent and potentially highest level of 2018 if we do see that reversal take place on the intermediate time frame to come on back into that larger primary bearish trend which is still in effect for the US dollar. So again, stopped out, place hard stops on any of these trades or any trades that you want to get into. because again, it just stops you from holding on to a bunch of, unfortunately losing positions from time to time. GLD, a major surprise. Same with SLV. Actually, I can talk about SLV at the moment. You can see here it's coming back down into the support area, and very similar to what has sort of transpired on GLD most recently, it looks as though we are breaking support. I mean, 1480 is a pretty good sort of target. But at the same time, I mean, if we go back and have a look at this, you can see here, if I can bring up on the weekly chart, I mean, how much cheaper are these commodities going to actually be? If I go to the monthly chart, pay attention to this. I mean, all the way back in 2008, we were as low as about $10 on the ETF. We're at 15 at the moment, but largely for a number of years, we've been absolutely moving sideways. If not, we've just been in a larger continuation of that of a bear market on SLV, and really largely commodities as well. So, I mean, the question needs to be asked. I mean, in reality, I mean, how much cheaper can these ETFs get, or at least the commodities themselves? And I don't think there is all that much downside, and I am really looking to take advantage of that turn when it does come, because I think it is going to be quick, it's going to be volatile, and a lot of people are going to miss out on that rise. All right, so that's going to do us at the close on Wednesday. If you have any questions, email me. Otherwise, let's be very focused as we move into Thursday's session, and we'll just have to monitor this price action and find that base when it does set up. But we are looking for lower prices, at least for the remainder of this week, okay? As for now, though, I'll say farewell. It's James saying goodbye on behalf of Pivot Point Trading. All the best, everyone. I'll be back with you again in due course. Goodbye.